Good afternoon, everyone, and welcome to this FETF webinar. In this session, we want to address two key questions. Why is risk-based supervision essential to the combating of money laundering? And how to conduct effective risk-based supervision? I am Valerie Tay. At home in Singapore, I supervise the financial sector for financial crime risk management. At FETF, my role is to co-chair its policy development group, and PDG recommends changes to the FETF standards to address new risks and also produces guidance to support implementation of the standards. For RBA supervision, the topic of our discussion today, FETF produced guidance in March this year, which we will run through as we go through the questions that we have for our panelists. Joining me on the panel today are three contributors to the guidance: Philip Berthaud, Hamish Armstrong, who along with a colleague of mine at the Monetary Authority of Singapore, co-led the production of the guidance, and they were shepherded by Shana Krishnan from the FETF Secretariat. So let me invite Philip to join us. Philip heads the AML CFT Directorate of the French financial regulator, ACPR, at Banque de France. Philip also chairs the AML expert group at the Basel Committee. Hamish is Chief Advisor on AML issues at the Jersey Financial Services Commission, which supervises both financial and the non-financial sectors. We have two other panelists representing important stakeholder groups who are also with us today. First, Chris Calabia, who's Senior Advisor at the Gates Foundation on regulatory issues, and his strong interest is in financial inclusion. And finally, John Cusack, who chairs the Global Coalition to Fight Financial Crime with a private sector view. Before we start our fireside chat today, for the audience at home connecting to us on Zoom, you can send our panelists your questions using the Q&A box on your screen, and you can also vote for questions. We will start this discussion by hearing a round of insights from our panelists, and we will have time for Q&A afterwards. So my first question is to Shana. From your vantage point at the FETF Secretariat, how well have jurisdictions done in implementing risk-based supervision, and what desired outcomes have been achieved as a result? Shana?
Thanks, Valerie, and hi to everyone who's joined on the webinar today. For the FATF, this is a really important discussion because only 10% of the countries that have been evaluated are actually effectively supervising the private sector. That means that there are around 90% of jurisdictions that still need to make major and fundamental improvements in relation to supervision. We have made some good strides in making sure that the rules and the mandates are in place for risk-based supervision, but the difficulty is really in translating this into real-world implementation. There are a range of problems that we cover in the guidance, but I just want to pinpoint a few things today. One of the main issues is that supervisors don't always have an up-to-date understanding of the risks. And this is really hampering their ability to focus on the most important issues and to actually take those risk-based decisions and apply the discretions and flexibilities they have in hand. If they lack the confidence, they may be, referring to a tick box approach, which is not what we want to see in relation to supervision. The second key point I want to make is about the non-financial sectors. So what we've seen is that regulation and supervision of the financial sectors is often much stronger than the non-financial sectors, such as lawyers, accountants, casinos, real estate agents. And often this is leaving a gap in the overall supervisory systems that countries have in place. And the last point, and probably one of the most important points, is that often we see countries trying to implement a risk-based supervision regime in the year of their evaluation. And while this might work for putting in place some of the rules and processes, it's certainly not enough time to really test the system and to demonstrate your effectiveness. One of the other questions you asked me, Valerie, was about, what do we expect when a system is working well? What are the final objectives of the supervisory regime? And there are two main things for me. The first is that we prevent dirty money from entering the system at all. And that's ensuring that the private sector understand their risks and they're applying their resources to address the most important issues. The second thing is, if dirty money does make its way into the system, that the private sector has the tools to detect and to report this activity to the financial intelligence units and the law enforcement agencies, so we can actually pursue these activities criminally. And what we see is really that supervision is at the foundation, it's really at the base, the starting point of the whole anti-money laundering system that FATF is really putting in place. And that's why it's really important that we're having this discussion with the stakeholders that we have today.
Thank you, Shana. And I'll turn next to Philip and Hamish, who are both senior supervisors with deep experiences. And maybe you could speak to us about the challenges that supervisors must address given our finite resources, and also how to execute supervisory strategies to meaningfully improve risk management in our regulated entities. Starting with Philip and then to Hamish. And before I turn to them, I remind the audience that you can start typing in your questions and voting for questions as well. Go ahead, Philip, over to you.
Hi to everyone. I would say that the guidance states that the transition from rules-based supervision to risk-based supervision takes time, and I would add it's not a straightforward and easy transition. Part two of the guidance highlights a number of the challenges associated with that transition. I would stress one issue among others, and that the issue that you need to build upon a reliable, consistent and accurate set of qualitative and quantitative data to build the risk-based approach. And probably the quantitative data are the more difficult to get. In part, qualitative data can be obtained through cooperation with other supervisors, prudential supervisors, the FIU, and the law enforcement agency. But you need quantitative data that can provide you with a relevant set of risk indicators, and that's quite challenging. And so the section 5 of the guidance gives a number of examples on how to handle that issue. I think this issue needs to be thoroughly thought of, both in terms of its alignment of the alignment of the data with the supervisory strategy, and also in terms of the burden it imposes on obliged entities. So you need to be quite ambitious, but realistic, so a delicate balance in itself, and be prepared to build your data and your system over time, step by step. And on your second point, Valerie, about how to improve risk management, I think, well, again, the guidance provides for a lot of best practices and examples to set up an effective risk-based supervisory strategy. But I think that the 4 principles that are highlighted in paragraph 61 of the guidance are key, because they frame the mindset that one must have when embarking in the development of a risk-based approach. Those 4 principles, I would go over them very quickly: outcome-focused, risk appropriateness, efficiency, dynamism, and responsiveness. So altogether, those 4 principles that I would say trickle down in the most of the guidance, or inform the most of the practices that are highlighted in the guidance. They make for the very sound foundation for the risk-based approach. So again, a very specific mindset. Thank you.
Thank you very much, Philip. And over to Hamish, particularly on the DNFPP sector or the non-financial sector, where the players are quite heterogeneous and numerous. What would be your advice to the DNFPP supervisors?
Yes, thanks, Valerie. I think it's important to stress at the start that the risk-based approach as a concept is not necessarily new. The risk-based approach kind of in some form has been in place in a lot of organizations and governments and even in some supervisors in some form, because essentially we all have a lot of tasks and a lot of things to do and finite resources. And so this idea of a risk-based approach of deciding where to put your resources, where to focus your energies to get the best outcome is not necessarily new. But what is new, of course, is the way it's been embedded into the FATF recommendations, and this particular focus going forward, particularly for AML/CFT, on the money laundering, terrorist financing risk, and that is what some supervisors, as we see, are struggling with. And as Shana did mention, there is some good practice out there, and we see a lot of good practice, particularly in the financial supervision. But it's fair to say, I guess, when you look across the MERs, a lot of jurisdictions are struggling with DNFBP supervision, particularly, even when those same jurisdictions or even those same supervisors may have a reasonably good handle on financial sector supervision. So what this means really is that a lot of supervisors are building or starting their approach to risk-based supervision from scratch, if you like, from a very, very low base point. And what it requires really is sometimes a change in culture in the supervisor and a change of mindset, if you like, as well as actually practically building the systems and the processes that are required. And for DNFBPs, for the designated non-financial businesses and professions, and this, as Valerie said, is where I kind of focus my efforts in helping pull the guidance together. This is where I try to get a lot of input from DNFBP supervisors. What we're hearing from DNFBP supervisors in particular is there's even more complications due to the nature and the features in the DNFBP sectors. And really, this kind of springs from a number of factors. And firstly, quite a lot of these DNFBP sectors, not all of them, but quite commonly, these sectors have little or even no experience of being supervised. So these sectors may not be prepared or even able to provide the information and the data in the right format or in the manner that the supervisor might want or require in order for the supervisor to make a proper informed assessment of risk of that sector. And in addition, the AML supervisor may have no previous relationship or supervisory history with that sector. So the supervisor has no real standing data or understanding of even things like the business practices in that sector, what the risks are in that sector in particular. And naturally what the control frameworks are like, what the robustness of the controls in those sectors. So this is kind of the problems around gathering data and understanding that risk. And then of course, when the DNFBP supervisor tries to implement a risk-based approach based on that understanding, sketchy or broad as it may be, we're often looking at very, very large numbers of individual entities. I mean, I hear from supervisors talking about thousands and in some cases tens of thousands of small industry participants and spread over numerous types of sectors and products. It's a very, very tough job. And of course, these problems are not just apparent in DNFBPs, but what we hear from supervisors is they tend to be more prevalent in DNFBPs. Mainly because, as I say, the supervision of DNFBPs in general, not always, but in general, tends to be slightly behind the financial sector supervision, which normally has that kind of history of conduct and prudential supervision already as a good base to start from. And what we see in the DNFBP regime is that they don't really have that base to start from. So that job of building a risk-based approach to supervising DNFBPs is just that little bit more difficult. In terms of what to do about it, as Philippe said, we do set out quite a few ideas in the guidance paper. What we did is, Shana mentioned that there is some good practice out there. There are a lot of supervisors who are doing this well. And so what we try to do is gather ideas and suggestions and techniques from supervisors who were doing it well and set those out in the guidance. So, I mean, I can't rattle through them all. It's hundreds of pages. But things like, for instance, a couple of examples, if you are struggling with, very little risk data, particularly on a wide number of entities, why not start with risk rating on a sectoral basis or on a cluster basis, just to start with, and then refine your risk data collection and analysis as you go along. You can have a very simple, broad data collection questionnaire or data collection exercise with very broad indicators just as a starting point. And when you're dealing with very, very large numbers, you could even approach your supervisory outreach and engagements on a cluster or a subsector basis. Particularly when there's subsectors which have similar institutions and it's impractical to perhaps supervise them all on an individual basis. I would say, especially in the DNFPP area, where you do have this large number of institutions, think about making more use of guidance and outreach to supplement your supervision, so that at least the entities that may not be subject to direct supervisory intervention, at least those kind of entities may have the tools and the information so that they can at least self-assess, do their own sort of gap analysis, and hopefully align themselves with the best practice that you as a supervisor are actually giving to them. So that's a very, very quick overview of, as I say, some of the challenges in particular in the DNFPP sector, but again, a couple of examples of the kind of thing that we've included in the guidance that will hopefully help supervisors to meet some of those challenges.
Thank you, Hamish. So I would like now to move to John for the view on the other side. He's led global compliance teams at major banks. So John, how have banks benefited from risk-based supervision, and what can supervisors do to be more impactful at guiding financial institutions to better manage their risks?
Thanks, Valerie. And I think, Valerie, we're all on the same side as opposed to the other side. We're all trying to fight financial crime, but I take the point. Look, kudos to FATF and to the supervisors getting together and putting this amazing document together, which is a huge amount of best practice from some really good practices from some of the best regulators and supervisors around the world. So it's a really important document. I commend everyone to read it, not only regulators, but people in the private sector too. We've been discussing the rules-based approach versus the risk-based approach for many, many years, and we're further along than we've ever been, moving away from a technical compliance approach to one which FATF certainly promotes, which is all about looking towards outcomes and effectiveness. And supervisors have been on that journey as well. The banks actually raised it with FATF back in 2004. I was reminded yesterday, talking to one of my colleagues. And we raised the risk-based approach with FATF to move away, as I said, from this rules-based approach. But what I'm always interested in when you talk about risk-based approaches, everyone has a different definition of what it means. And I think it's important to go back to understanding exactly what we're talking about and whether or not actually we're talking about the same thing. Okay, so from a bank's perspective, I think we're talking about the fact that there's not a zero tolerance approach that is realistic or possible. Right? We all recognize the fact that financial crime is unwanted, but it exists within financial institutions, it exists within the industry, it exists within society at large. So do we all accept that a zero tolerance is not possible? Yes, I think we have to, and I think we've moved along from those early days of saying, you have to be 100% perfect and have ultimate prevention and detection, which I think is useful. I think the other concept that the banks have always said is, one size doesn't fit all, right? And I think with a rules-based approach, to a certain extent, that's challenging. We all know that financial institutions in particular are different. They also come at things with different risks and also how they want to respond to things, obviously within an overriding framework. And lastly, I think this concept within financial institutions with the risk-based approach was, look, we think we should be doing more where the risks are higher, and that's financial crime risk, not necessarily per se regulatory risk, right? We think we should be doing less when those financial crime risks are less, which sounds obvious, but it seems to me that, and to many of us, that actually the current model we've got is you need to do a lot when the risks are low, you need to do even more when the risks are higher. Right? Now that may be unfair, but that's somehow how it feels. Simplified due diligence, for example, in the real world is very rarely undertaken. Right? It's pretty heavy due diligence in all cases. Now, I do believe that regulators pretty much accept that a zero tolerance approach is not realistic, but they still have trouble with expected loss. Right? Financial crime risk is just like other risks, right? Credit risk, market risk, operational risk, fraud risk. There's got to be some sense of expected loss in there, not expected intentional loss, not that people are intending to launder money, but that inevitably monies will be laundered through financial institutions. Controls will not be 100% perfect. Customer files will not have everything in them, even though that's the aspiration. And I think in reality, regulators have done a pretty good job of recognizing that in practice. and only turn up with fines and penalties when you've got either significant carelessness, or you have willfulness, or you have egregious cases. So I think, to your point, Valerie, what have regulators done? I think notwithstanding the law is black and white in relation to this is what you must do for every single customer and all transactions. The reality is regulators are much more reasonable in relation to the realities on the ground when they're looking at that. So I think that's really important. I have some sympathy with regulators, though, in relation to the risk-based approach, because it's very difficult to make a judgment as a regulator in each individual case and substitute your judgment for that of the financial institution, right? Because it's a very difficult thing to do. It's also a very dangerous thing to do. But I do think getting involved in the substance of discussions rather than the fact that a process exists and is carried out on a regular basis, I think is part of the future of best-in-class supervision, right? Challenging in relation to some of those substantive elements and not just talking about the processes themselves. As many of you know, I think one of the answers to the future of risk-based supervision is to move beyond the current model of looking at technical compliance or regulatory compliance, a bit like the 40 recommendations, and having the aspect that FATF have got with the 11 IOs to move towards a balanced approach of saying, yes, technical compliance is important, albeit you're never going to be 100% technical compliant as a large financial institution. But more importantly, I think you've got these other elements that the Wolfsburg Group promoted in relation to its effectiveness proposals. And you've got these 4 elements, right? The first element is, yes, you need to be technically compliant, but it's unlikely you're going to be perfect. Secondly, you need to have reasonable risk-based controls that mitigate the financial crime risks to an acceptable level. And thirdly, let's not forget the purpose of this exercise, which are the outcomes, which are we're here to prevent money laundering, but also to provide high-level intelligence to law enforcement in order to be able to do their job. There's a fourth element that I think Chris will cover next also, which is this question around unintended consequences and friction within the system, which I think we all have become much more attuned to than we ever did in the past. So I'll leave it there, Valerie. I'm sure Chris will pick up on that latter item, and we'll discuss that further, no doubt.
Thank you very much. So nice segue to Chris. Chris, your interest, of course, is in financial inclusion and the enabling technologies. So why should AML supervisors pay more attention to whether their regulated entities are unduly de-risking customers? And what competencies and strategies should supervisors deploy?
Valerie, one reason that AML supervisors must pay attention to the undue de-risking of even poor consumers is simply because exclusion is a risk as well. And FATF's latest guidance on risk-based supervision that we're discussing today goes so far as to say that financial exclusion holds serious money laundering and terrorist financing risks because unbanked consumers may have to rely on the unregulated economy, or they may have to rely on intermediaries that lack sound risk management practices and so on. At the Gates Foundation, we believe that every person deserves the chance to lead a healthy and productive life. And research shows that when poor consumers gain access to appropriate digital financial services, they're better able to save, to borrow, to make payments, and to invest in their family's futures. And in short, they're better able to lift themselves sustainably out of poverty. Now, I'm sharing some personal views today, but as a former supervisor, I would say that from the AML perspective, financial inclusion means that more activity is taking place inside the formal economy, which increases scrutiny on the transactions and also adds frictions to those who might try to evade controls. That's a good question to ask about what competencies and strategies, say, supervisors might need to exercise this oversight. And we focus on the needs of low and middle income countries, supervisors, and central banks. And their needs are in many ways no different from the supervisors of other countries. They need 4 things to do this well. They need good data, they need good systems, they need good people, and they need good rules. As more and more transactions move into the digital world, there's no shortage of data for supervisors in any country to be able to look at, as well as for providers. So the differentiator for some supervisors is in the other 3 categories. And one of the challenges that supervisors in low and middle income countries often face is that they have a lot of data, but they've got to be able to translate that data into databases so they can manipulate them. In some cases, supervisors are still receiving paper-based reports from supervised entities, and that has to then be brought into databases so they can be manipulated. Even if it comes as a PDF, there's still a lot of effort that it takes to put it into a database. And so a lot of effort is spent trying to get that data in. So technology is as simple as things like web portals for uploading data or APIs for supervisors to gather data can make a big difference for some of these supervisors in low and middle income countries. And one of the ironies is that as you increase the amount of technology that you use in the supervisory authority, you must also increase the quality and competency of the staff, because you need more staff who are going to spend more of their time working on higher value analytical tasks, which is much more interesting for analysts anyway. And so you do need to invest in the capacity building for those staff in these agencies. And then the final thing, of course, and one of the important differentiators for many countries is having good sets of rules. And that's where the risk-based guidance is so important, because especially in countries that are resource constrained, we want them to be focusing their attention on the higher risk activities. At the same time, we don't want them to be putting undue attention on lower risk activities, including those of low income consumers and low income households. And we want to make sure that those households are able to participate in the system so that their activities are also part of the supervised world, and that they benefit as well from participating in a modern economy.
Thank you very much, Chris. So we'll now have some time for questions and answers from the audience. And looking at the Q&A box, I see that we have two top questions. The first set of questions I will pose to Philip and Hamish, because they are asking the supervisors for expectations on the scope and depth of a verification that we do as supervisors when we perform risk-based supervision. And I'll add to that the frequency of supervision as well, both off-site and on-site. So that question to Philip and Hamish. And the second question that has received the most votes asks what risk-based approach mean for fintechs. And perhaps I will pose that question to both Chris and John for your views on that, on whether risk-based approach works for fintechs or should work better. So first, over to Philip and Hamish on the first question about the scope and depth of supervision that we do, and also might add to that the frequency of supervision. Philip?
Yeah, I would say that in a risk-based approach context, actually there is more to supervision than the inspection cycle for higher risk entities. And I don't mean by that that we can get rid of this. To the contrary, it's essential, but it's only one building block of a comprehensive RBA or risk-based approach. Such a comprehensive risk-based approach should encompass other risk sectors and entities other than the higher risk ones, with a view to have a clear focus on higher risk or emerging risk, but along with a proportionate approach towards the lower risk entities. And to quote from the guidance, it ensures that there is a risk proportionate distribution of resources across the different risk areas and sectors. So it's quite difficult to say definitely whether well, to put it differently, there is a need to obviously adapt the cycle, scope, depth of any inspection, examinations, reviews, whatever the supervisory tool is, to the level and nature of risk. And that's what the risk-based supervision is about, the adaptation to the nature and level of risk.
Thank you, Philip. And Hamish, your view.
Yeah, thanks, Valerie. I'd support what Philippe says there about the understanding of risk driving the selection of your supervisory tools and the type of engagement that you have with the supervised entities. But what I would add to that, and again, this is with my DNFBP supervisor hat on, if you like, is firstly, don't ignore the lower risk sectors or subsectors or entities. All the sectors, all the entities must be subject to appropriate AML CFT supervision, that is commensurate, with the risk they pose, as Philippe referred to. So it's important for a supervisor, and I'm thinking particularly here about single supervisors. So a supervisor who is responsible for, perhaps both financial and NFPP sectors, which is the example of the supervisor that I come from, but it's not that uncommon. So it's important to have a strategy that sets out your approach to the full range of subsectors, sectors, and entities. Both higher risk, medium risk, and lower risk. And you must have an appropriate strategy that sets out how you're going to deal with those low risk sectors. And some of the examples again that we give in the guidance paper, things like having a less frequent supervisory cycle, as Philippe referred to. But in fact, you may not have a supervisory cycle at all for low risk sectors or low risk entities. And we do say in the guidance that you might want to think about some kind of random sample testing, combined perhaps with reactive interventions as a way of dealing with those large numbers of low risk entities. But we do make it quite clear that we're not necessarily expecting every single lower risk entity to be covered in a cycle. Think a bit broader than that, and think about different ways you can use your resources. And of course, think about offsite tools. It's not just about on-site inspections here. Think about the use of offsite tools to kind of supplement the on-site activity that you are undertaking. But I would say, and this is what we're hearing from a lot of supervisors, is it's really important to test your assumptions about those low risk entities and about those low risk sectors. What we want to avoid is, if you like, a kind of a self-fulfilling prophecy, whereby there's a sector that's low risk, so it doesn't get much supervisory attention, so you never have any findings, you don't know much about it, and it just remains kind of in the corner, if you like, without much attention. So I would say, always use this idea of random sort of sample testing to at least verify your assumptions about the risk and the behavior and the control frameworks in even those low risk sectors. And in addition, always be ready to apply more resources, more intrusive supervisory tools to a low risk entity or to a low risk sector, where it's necessary. So for instance, where you have some intelligence or a particular risk crystallizes. So even those low risk sectors, it's okay to do less. It's okay to use less intrusive tools and not necessarily have a cycle, but you do need to have some kind of appropriate supervisory activity that will give you the comfort that those low risk entities are appropriately complying with their obligations. That's no easy thing to do, as we all know, but as I mentioned, there are quite a number of suggestions and techniques in the guidance that will hopefully help with that.
Thank you very much. And I wanted to thank Antoine for that question. So over to the next question, and I wanted to start with Chris about the opportunities for fintech to leverage on the risk-based approach. And this is a question that Chaitali had posed in the chat box. So Chris, to you.
Yes, thank you, Valerie. So it's a terrific question. So we care about bringing in two sets of entities into the financial system. So one we've talked about a little bit already, and that is bringing in unbanked, the poor, and underserved women into formal financial services. And we want to see the risk-based approaches applied to them so that they can deal with challenges like lacking identity, a challenge that's particularly large for women in low and middle income countries, where women tend not to have the same suite of identification documentations as men do, making it harder for them to open accounts. The other group that we care about is bringing in providers who can best serve the poor and people living in rural and remote areas. And traditional commercial banks have a very high cost structure, and they're not likely to build branches in highly impoverished areas, understandably, because the costs are high. But digital financial services providers can reduce the cost of serving the poor by about 90%. And if you think about something like a mobile network operator, or today maybe a social media company or a big tech firm and so on, fintech firms, these firms have cost structures that enable them to serve poor consumers. And so offering basic financial services can be one way to bring them into the financial system. And if you think about how should we supervise them, certainly we believe that these firms should also be subject to supervision, because we want them to be operating safely and soundly. We want to see financial integrity in financial systems, and we don't want people to lose confidence in these firms to serve the poor and the public well. And we want to make sure that they aren't undermined by things like abuse, whether that's money laundering or financing terrorism. And so if you apply the Financial Stability Board's rules of same business, same risk, same rules, we'd like to see similar types of rules being applied to financial service companies that might be based on new technologies or new types of business models and so on. And some of these firms actually are already subject to rules that are similar to what we would expect in the traditional financial services world. So for example, in some countries, you can't buy a phone or a SIM card without proving who you are. There's a basic know your customer rules, but those rules are often different in terms of getting a SIM card versus opening an account. And it would be interesting to see if we could align those rules a little bit more easily so that it would be simpler to get a phone and then open an account. So we would like to see them subject to risk-based supervision. We would like to see supervisors paying attention to them. And we think it's important for safeguarding the financial system and protecting especially new consumers and poor consumers against risks.
Thank you, Chris. And John, do you have some insights to add to that question?
Yeah, Valerie, I think, fintechs, who's a fintech these days? I think everybody's a fintech, aren't they? It's not just the new kids on the block. Everybody's got a digital bank. Everyone's got an offering that's increasingly digital, and technology is a very important part of how people deliver financial services. But the way we think of fintech with the startup and the new offering of different products and what have you, maybe a rules-based approach is better for them, Valerie. Maybe actually people assume incorrectly that risk-based approach is the easier way, but it's not. Rules-based approach sometimes is just tell me what to do and we'll do it, right? That's one approach, which I don't like, that. But the risk-based approach means you have to understand the nature of the risk really well, right? You have to have tailored controls over and above the regulatory minimum, which are specific and precise and respond to the particular risk that you face. That's not easy. That's not easy at all. And you have to have lots of competence, which means cost, in relation to getting that right. So some fintechs who look at risk-based approaches doing less isn't very smart. Some fintechs that look at risk-based approaches as doing more, where it's necessary, I think is relevant. I think where fintechs though can also help us all is this concept that we should be doing more in relation to sharing competence. And why is it that we're all doing pretty much a similar thing or trying to do a similar thing on our own, in our own environments? And I much like the work that happens in the cyberspace, Valerie, where there seems to be a lot more collaboration in relation to dealing with what is a threat against all of us, against the whole ecosystem, against society, right? Financial crime is exactly the same, right? Financial crime threat, and particularly the fraud threat, is a threat against each and all of us. So we should be sharing more, also on competences, more utilities, more collaboration, more partnerships. And I think fintechs were more naturally, I think, collaborative than some of the older ones in the industry, albeit, as many of us have been working together for many years. I think that is a way that we can actually significantly improve. And if you want to do a risk-based approach, which is tough, then get together and work out how you can do that collaboratively, collectively.
Thank you very much. And on your last point, there was a question about collaboration. It was posed to Shana, but I would equally pose the question to Philip and Hamish and other panelists as well about collaboration between supervisors and the FIU, and to add to John's point that there are opportunities for collaboration with industry and between industry. So maybe Shana, you want to start us off by addressing the opportunities for collaboration between the FIU and supervisors and what outcomes that could achieve.
Thanks, Valerie. And actually, I was mentioning it before to the panelists. It was one of the issues often raised by the private sector in some informal consultation we did on the guidance. So one of the comments that we received was that sometimes the private sector gets different messages from different authorities in a jurisdiction. And what they asked for is that some of the authorities were more coordinated in their understanding of risk and their expectations of the private sector. And so we've really tried to bring this out in this guidance. And I think one of the important points is there is this natural need for supervisors and FIUs to speak often and regularly, partly because one of the main outputs from the supervisory system are some of the STRs, the suspicious transaction reports that are submitted to financial intelligence units. And those financial intelligence units will have really important information about how regulated entities are actually performing and where they need to focus more. And so that's something that we've really encouraged as part of this guidance.
Thank you, Shana. Maybe Hamish, you want to take this on as well, the opportunities for collaboration with industry, as well as between the competent authorities in the jurisdiction.
Yeah, thanks, Valerie. I mean, I just echo what Shana says, and as usual, Shana summarised it pretty well. But absolutely, I think there's a need for closer collaboration between particularly the supervisor and the FIU, and it's a two-way street really in two kind of instances. Firstly, in that risk understanding, because a lot of the risk knowledge and the typologies and is coming from the FIU. That kind of knowledge is in the FIU and other law enforcement. And that's the kind of data and information that a supervisor needs to make its risk assessment of its various sectors in order to apply its risk-based approach properly. So you need that collaboration from that point of view. But again, as Shana mentioned, one of the whole points of this, of having a risk-based approach to supervision, not only is it to discourage the use and abuse of the financial and non-financial sectors by money launderers and terrorist finances, but it's also to enable law enforcement to have that information about those players when it's needed. And we're still seeing examples in some jurisdictions and some supervisors where even just the terminology that say a supervisor and an FIU are using are different, and there's a mismatch in the way they store data and the way they analyze data and information. And it's something that we do see some good practice on, but we see increasingly not quite so good practice, and there's still quite a few challenges there. And this is kind of moving away a little bit from risk-based approach to supervision and moving more into kind of national strategy and national coordination. But those are equally important. And that's why we did try to touch on it a little bit in this guidance paper. Although, as I say, it's a more broader issue around the national approach to AML CFT. But that's not to say it's very important for risk-based approach to supervision for those two particular reasons that Shana just mentioned, and hopefully I expanded on a little bit.
Thank you, Hamish. And I wanted to thank Ruta for that question. And to Philip, adding to that question, there was a related one from Nick Burbridge about the sharing of information between prudential supervisors and AML supervisors. So that's right up your alley. Maybe you want to offer us some insights from that perspective.
I think it's the sharing of information is critical for mitigating risk to the financial sector and building trust. I would use a kind of analogy. Effective information sharing between correspondent and respondent banks is key in the correspondent banking relationships. Failure in information sharing, for instance, in RFIs related to CDD, can lead to the loss of a relationship. And I think it's a bit the same within the supervisory community, especially cross-border. And so effective cooperation and information sharing between supervisors is really instrumental to the, I think the guidance makes clear that the risk-based supervision should lead to a holistic view of the risk of any sector, of any obliged entity. And to have that holistic view, you have to look way beyond the AML CFT systems. You have to look at the risk culture. You have to look at the risk, the third line, the three lines of defense. You have to look to the governance of the entity, and to have a very comprehensive view as an AML CFT supervisor. You have to talk to the prudential supervisors, which is sometimes better place to have a broader view of those issues, which are again very important in your own supervision. So, and I would stress that that's an issue, obviously, that we stress in the guidance, but also that the Basel Committee on Banking Supervision issued last year and a new version of its own guidance on sound management of the AML-TF risk, with a dedicated appendix on how to develop, to implement the cooperation between supervisors, including between AML-CFT supervisors and prudential supervisors. So I would commend that guidance as well on this particular issue.
Thank you very much. There were a few questions about the risk indices that supervisors should look out for in conducting risk-based supervision. So to the point that Philip just made, that when we conduct risk-based supervision, we need to take a holistic view of both the system as well as the individual regulated entities. So I wanted to ask the panelists whether they would like to discuss a little bit about the risk indices that you either as a supervisor focus your attention on, or as the regulated entities you wish your supervisors were focusing more attention on. Maybe we start from John's lens, because John's having spent many years as head of global compliance in key big banks, probably have insights in this. John, do you want to start us off?
Yeah, thanks, Valerie. Yeah, we've thought a lot about this over the years. In the old days, it used to be passing your reg exam and not having a bad audit, right? That was ultimately the only test that was really important. When we move on from that, there's many other things that we really want to see, and that our boards really want us to be successful in, and that's to understand the nature of the risk and be able to discuss what that is and what it looks like in real terms. What kinds of risks do we actually face? What does it look like? And how really are we protecting the organization and wider society from those risks? So a really good understanding of the risk and be able to explain that. Also, how the controls actually work and whether they're operating in practice. Not like the old days, which was if you don't have evidence it's not working, it's okay. No, you need to have evidence that it's working, right, on a regular basis, but not working perfectly or working within risk appetite. And that's a difficult area. What's risk appetite? How big is risk appetite? What's expected loss? Having views about all that is really important. But at the end of the day, it's not about just complying with a set of regulations or having a bunch of controls, right? The outcome that FATF is looking for is prevention and detection of financial crime. So what are we doing? What are we finding? What are we preventing? And what are we helping law enforcement in particular? And is our cooperation with law enforcement meaningful? And that also requires a bit more feedback from law enforcement, but an engagement there as well. And there are leading institutions, Valerie, have very detailed scorecards across all of that, and increasingly also around unintended consequences as well. Right? Now, increasingly, regulators are asking for a whole bunch of data, AML questionnaires from financial institutions, which some of the data is useful, I think, for them to be able to identify who's risky, but oftentimes it's who's big and what size business you have. I'll give you one example, Valerie, of something that I wasn't impressed with, just to put it on the table. There's a continental European regulator that asks 50 questions of its financial institutions. And one of the questions is about risk assessment. And there's 5 questions on risk assessment, all around, do you have one? When did you do it? How is it done? But there isn't a question on what's the result. Right? And I think that's a classic case of technical compliance versus outcomes or effectiveness. And I think collecting information is all well and good, but it's got to be for a purpose beyond simply helping the regulator do, if you like, their assessment. It's also got to be around ultimately what is the point of this thing and is it having an impact on ultimately what we're all here to do. So I think there's progress, but there's still a ways to go.
Thank you. I'll go to Chris next before we sort of round up with the supervisors. But Chris, from your lens, what are some of the indicators that supervisors should be watching to assess whether or not a regulated entity is, de-risking indiscriminately or could do better in adopting financial inclusion policies, for example?
It's a good question, and it's a hard one because it's going to vary from institution to institution and country to country. But one thing to look at is, first of all, especially if a country has a financial inclusion mandate or an objective, is just seeing how many people actually are able to get access to new accounts, and looking at particular groups of people. Are women able to get accounts at equal rates as men, for example? Are poorer consumers able to get access to accounts at rates that are comparable to those of wealthier consumers? So I think that would be one set of topics to look at. But also important would be to look at the number of transactions that are actually done. If you open an account and don't use it, it's not improving your life. It's not making it possible for you to conduct your payments more safely or to borrow and so on. So I think looking at the usage of these accounts and who's using those accounts also matters a lot. And if you see that account usage is deepest among people who are already deeply financially included and already in wealthier levels of society, you should ask yourself whether your rules are too restrictive. I think one of the interesting things that we have found through research that we and others have sponsored is that low-income countries tend to make use of the simplifications and exemptions in FATF's rules to a far lesser degree than wealthier countries do, even though many of those simplifications were designed explicitly for low-income countries to try to help them improve financial inclusion. And so I commend FATF for thinking more about these unintended consequences and for launching efforts like this recent guidance published on the risk-based approaches to supervision to encourage supervisors to think about the fact that not only are these approaches acceptable, they can also be important in terms of, first of all, making sure that more and more transactions are conducted within the supervised economy, but also in terms of achieving important development goals and financial inclusion goals. And so I commend FATF's work and continued engagement on this subject and look forward to continued dialogue on that going forward.
Thank you. Philip and Hamish, do you want to jump in on this debate?
I would say that one thing we've been looking at is something that is quite similar to what John mentioned a few minutes ago, is that how financial institutions determine their high-risk clients or high-risk activities, and who those high-risk clients are, and what are the high-risk activities. And actually, it goes both ways. It's interesting for us to gauge their own framework and to have a better view of their risk exposure. But it can also feed into our own sectoral risk assessment, because we have to bear in mind as supervisors that the obliged entities are on the front line and they have direct contact with customers, and they are better placed sometimes to identify new risk. So it's quite useful to not only to the supervision, but also to our own risk assessment.
Thank you. And Hamish, do you want to jump in?
Yeah, I mean, if we're thinking about or talking about risk indices, to apply to institutions and some sectors, I mean, this is where some of the problems that I've mentioned earlier around NFPs actually comes from. In a lot of cases, the financial sectors, there's a lot of history of prudential and conduct supervision and a lot of knowledge and information. And so there may already be quite good, risk indices, risk understandings. The supervisors may have a good broad understanding of what to look for and what represents a higher risk. But in other subsectors, that information is just not there, which is why you might start seeing some quite, if you like, basic questions being asked. And this goes back to one of the things that John mentioned earlier. Some of these questions might be quite basic that they're asking of their entities just to start off that risk understanding. But unable to get a proper risk-based approach across all sectors, the supervisors really need to understand the risk in the same kind of depth and quality across all the sectors. And this is kind of equally for a jurisdiction where there's multiple supervisors, but also for a single supervisor with multiple entities. I think that really is one of the big challenges to create these risk indices and guidelines of what to look for and what may represent higher and lower risk across all those sectors, particularly where you don't have that rich history and previous experience. And that is a challenge for a lot of jurisdictions, and as I say, particularly in the DNFP sector.
Thank you, Hamish, and thank you to Suresh and Ogiro for those questions on the risk indices. We have 5 minutes left, and I wanted to use the last 5 minutes to do a tour de table of our panelists for their key takeaways that they would like you to take from this session. May I start with Shana, please? Shana, you want to kick us off?
Sure, Valerie. I guess more of an issue that we didn't address too much, but it's really the role of supervisors in educating, providing guidance to the sectors. Chris touched on it a little bit here, but there is also a role for supervisors in providing the private sector with confidence also about understanding the risks, about applying risk-based measures. And that's something, especially when supervision is being rolled out to a new sector or, in relation to entities that don't have a good understanding, that's really important. So that's something that we really highlighted in the guidance. And the second point quickly is that, money laundering is real, it's happening. Some of the concepts we talk about sound theoretical when we talk about inherent or residual risk, but the crimes that money laundering supports and the harm to society is real. And so we need to really think about how this risk-based supervision is actually working in practice to address those issues.
Thank you, Shana. And over to Philip.
I would stress something again that John mentioned earlier during the webinar, and I think it's quite important, and the guidance goes a long way towards stressing that supervisors should avoid taking a zero tolerance or zero failure approach. The guidance deals about with this issue in paragraph 88, paragraph 81, and other in numerous occasions across the paper. The idea that every deficiency is equal, that inherent risk cannot be entirely mitigated. So, in effect, to make sure that we focus as supervisors on the real issue, and that there is more to risk-based supervision than only monitoring compliance. That's important, but it's more than that. Thank you.
Thank you very much. Hamish.
Yeah, thanks. As a final comment, I guess, I talked earlier about why risk-based approach is important and talked about managing resources, which is true. But I think really one of the real benefits of risk-based approach shows up in the outcomes. And the idea is that if we're focusing on the areas of greater risk, be that in the way we supervise, the tools we use to supervise, or even in the decisions we make about enforcement or prosecutions, this leads to actual changes in behavior, which is the point of the regime. And if we can, by applying a risk-based approach, change or improve behavior in the areas that are more important, the areas that pose the greater risk, we get the most beneficial outcome. We make a positive change that has a real life impact. And that is to preventing the harm that's caused by crime and terrorism. So risk-based approach is about managing resources practically, but for me it's more about getting the most beneficial and the most meaningful outcomes. And as I've said, there's a lot of struggles in the DNFPP area particularly. That risk-based approach requires good data, good risk analysis, good systems and processes, good people, as Chris mentioned earlier, and often at least one of those, if not more of those, are missing. But I would say you have to start somewhere, and there's a lot of good guidance in the paper that'll act as a starting point. So I would say, particularly for the DNFPP supervisors, start broad, start with something, and risk-based approach is a constantly evolving beast, and you've got to start somewhere. Keep developing it, keep refining it as you go, but start that process.
Thank you very much. And Chris?
Thank you. Well, if exclusion is a risk, then financial inclusion is an important part of financial integrity. And so I'd encourage people to look at this risk-based paper because I think it helps to advance the understanding about these issues. And to Shauna's point about supervisors having responsibility to educate the industry, I think we also need to think about assessors who come in to evaluate countries' compliance with these rules, because right now assessors take different approaches in thinking about exemptions and simplifications in the context of financial inclusion. And in some cases, it's because they're not familiar with what financial inclusion means and what risks exclusions presents. So I think making sure that assessors have a good understanding as well, and we can all think about these issues consistently, will be important. And thank you again to FATA for inviting me to join today.
Thank you. And finally, John.
Thanks, Valerie. So don't underestimate the importance of your role as supervisors. It is really important. If countries want to improve their FATF scores on effectiveness, then supervisors need to be right at the forefront of making that happen, because they are one of the keys to incentivize, both through carrot and sticks, the private sector in relation to its obligations. And we have to move away from or move beyond the traditional approach, and many have, but not quite at the target state yet, from this rules-based approach to a risk-based approach. But I'd even say a performance-based approach, where we're focused more on outcomes than we're focused on inputs. And regulation is classically, by its very nature, focused on inputs, and which is a proxy for achieving good outcomes, but it's not always the case. So I think let's keep our eye on the prize, which is ultimately the outcomes that we all have shared values in relation to what we want to achieve. I won't go back to the Wolfsburg Balanced Scorecard, but I encourage you all to look at it. It's a really different approach, which I think will make significant difference for all regulators to not only look at technical compliance, but to look at more risk-based controls, to look at performance-related outcomes for law enforcement, and also, to Chris's point, in relation to unintended consequences. I think it's a different way of thinking about regulators, but you've got to embrace it, enhance it, and talk about it as to whether or not actually that's something you want.
Thank you very much. It leaves me to thank all our panelists today for joining, to the many members of the audience who have come and made time for this discussion. We had more than 100 questions posed in the Q&A chat, so that shows the high level of interest on this topic of risk-based supervision. And with that, we go forth and do better. And I say good evening, good afternoon, good morning to everyone. Have a good day. Take care. Bye-bye. Stay safe.